Hi, everybody. It's Jessica Stone at Stansberry Research, and I've got Matt Weinschenk from Stansberry Research here. We wanted to talk to those of you who have a lot of questions about economic terms and specifically investment terms. We're hearing a lot of people talk about the subject of valuation right now, and I wanted to have Matt Weinschenk describe what is valuation, Matt.
Sure. So when you buy a stock, you're buying partial ownership in a business effectively. And so think about just buying a business that makes $1 million a year, right? Would you pay $10 million for that business or 20 million, right? If you were collecting all those earnings, what would your payback period be, right? Is one way to think about it. And when you're trying to arrive at that number, at that multiple, you would start weighing all sorts of different criteria about the business. You would say, is it a risky business? I'll pay less for a risky business. Is it going to grow, right? I'll pay more for a growing business. You would also look at comparable businesses like it and see what those are selling at. You would think about your alternatives. If interest rates were high, you could put your money in bonds and collect a good income. So you would pay less for the business because the bonds look more attractive. So that's, you could talk about a price to earnings ratio is measuring just that. How many years of earnings would you pay? But earnings isn't the only way to look at it. You can look, if a company has no earnings, or like a young growth company, you might look at price to sales. If a company is more mature and has a lot of actually true cash flow, you'd look at price to cash flow. You could also look at enterprise value to EBITDA, which is another measure. And it depends on what business you're looking at, what the appropriate measure is. For example, insurance and bank companies, a lot of times you go with price to book ratio, but really you want to combine these and sort of look at the whole, the investors call it the mosaic of different valuations and different ways to look at it. And the trickiest part, if you really want to get into it, is that when you talk about earnings, what matters for the value of a stock is the future. It doesn't matter what they've earned in the past. So when we say how many times earnings, we're talking about current or past earnings. Only because that's some sort of indication of what they might do in the future.
So valuation is really how valuable is that company to you as an investor, right? And you talked about a number of ways to judge that. I guess I think of a company like Amazon, which has tremendous stock value right now, and it just keeps going up and up. And yet we know that during much of its development, it has made little to no profit. So profit then is not an indication of valuation. Is that correct?
Well, it can be and it can't be. Amazon does not make a lot of income, right, as a specific financial statement. They don't make a lot of income because they make money on the products they sell, and especially their cloud computing business. But they plow those earnings back into the business to expand. One, to expand, right? And two, to reduce their taxes. You pay taxes on measured income. So they don't want to pay taxes, so they put it back into the business. They grow, they get into new markets, they expand their infrastructure. So when you look at Amazon, what you would consider their earnings power in a way, like how good that business is at making money, is not necessarily reflected in the earnings number that you look at for this year. So that's why you would want to look at some other things. You would want to look at maybe that enterprise value to EBITDA number. You would want to look at their operating cash flows to get a sense of how valuable that business might be. So it really is about pulling together some different thoughts and some different measures and understanding the business and having an outlook for it.
Matt, we're hearing all of these high-profile investors talk about how they believe the market is overvalued. What does that actually mean?
So the market is priced on expectations. When people have high expectations for growth and high expectations for income, or for earnings, I should say, then the market will have a higher valuation. Then for stocks to continue to rise, it has to meet those expectations. So when the market is richly priced, if growth stumbles, if companies don't post the earnings that people are expecting, it can't justify that multiple. And valuation is not very great for timing in the short term. So the next year or two, if the market, it can still get more and more overvalued. But looking at history, it is the case that if you buy when the market's cheaper, your 10-year returns are going to look better. Your 5-year returns might look better. So when they're saying it's overvalued, they're just saying, people are too excited. They're expecting too much growth that the economy can't really support.
When we hear that, what should we do with that as investors? Does that mean it's the wrong time to buy for some of us?
Most investors don't need to time these things. I think people think they have to get all in, all out of the market and get all in. And that's not the way to do it. I mean, you want to have, as a personal finance view, you want to have some stocks and you want to have some bonds, and maybe you have a 60-40. And if things get a little heavy, maybe you can switch down to a 50-50. You don't have to go crazy, but really sticking to your plan straight through the markets generally works.
Meaning, if you have a longer investment horizon, valuation and having a market that's overvalued shouldn't matter because you're not necessarily going to go to sell. But if you're going to go to sell, it might be a good time to get out because the market is going to give you more of a return than you got in for.
Absolutely, yes.
I think I've learned a lot today. Thank you very much for joining us. And if you would like to see much more content like this, including our special Stansberry educational content, please subscribe to our YouTube channel. You can also find us on YouTube, on Instagram, and on Twitter. Thanks so much for watching. That's all for now.